What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is October 29th of 2018. Well, folks, I hope you all are having a great day wherever you are. Today, we've got a lot of important things to discuss here in regards to the daily update. As always, we'll be taking a look at market valuations as well as doing some technical analysis on the market leaders. But outside of this as well, we've got a wide range of topics in regards to crypto and traditional markets. For crypto markets, we're going to be taking a look over a tweet that I put out last night talking about Bitcoin becoming a store of value, focusing in on something that I think many people have not noticed. Along with that as well, I'll be talking about three things that I think we need to see in order for Bitcoin to make moves higher. Along with that, I want to spend some time to give a quick update on Unibright, one of the projects I'm working for, as well as talking about the demise of Tether. But going on for traditional markets, we've got a wide range of things to discuss, some fundamental numbers, as well as a little bit of a scan over traditional equities and commodities. So lots of things to discuss. Let's not push it off any longer and dive right into the update. So taking a scan over markets over the past 24 hours, guys, we have been moving what can only be described in a sideways motion. Take a look across the board here, guys. Crypto, less volatile than traditional equities. This is absolutely insane. The top 100 are pretty much pushing sideways, and we can see this in market cap. Just to put it in perspective here, I mean, we can obviously see it here that we've built a high base here. Markets are stabilizing at a much more decent level. But take a look at really about a half of the month here, ever since we got the bump up due to the fears on Bitfinex. Look at how stable crypto is held in this market where equities are dropping 10%. I mean, it's just absolutely insane to see this. Now, I'm going to talk about why this is actually quite good. Obviously, yes, it's not December crazy awesomeness that everyone is probably looking forward to. But again, you need these types of sideways movement, really a building of, in this case, consolidation and support at a higher level in order to make higher moves. And we're going to talk about how Bitcoin has really been leading the charge in this. And again, the thing that I tweeted about in just a few moments. Going on here, though, taking a look at market dominance, again, doing exactly what we really need here. I'll go ahead and really scan the important part of this chart here. We generally need what, sorry, actually, let me expand this back a little bit more. We generally need this to continue doing what it's doing. As we take a look here, we need to have generally a double top here on Bitcoin dominance, and it looks like we're getting what we got back here in January and February of last year before we got the decline in Bitcoin dominance, aka the run up in altcoins. So again, looks like we're around the corner of a risk on market, but we're going to need a catalyst to do this. Again, we haven't seen crazy volume. As we go back up to this chart up here, guys, again, volume's been relatively stagnant. I bet a lot of it is market making, algorithmic trading. We need more retail and institutional volume coming in before we see any crazy major moves to the upside. And it might be a little bit, guys. We just got to be patient on it. So again, I'm gonna talk about some things that I want to see in regards to price action later on, and that could again cause some more excitement in regards to price action. But I think we're going to need a catalyst or something to come eventually. All right, so I want to spend some time. It's funny. I have a lot of ideas in my mind sometimes, and I very rarely believe that the world wants to read them in any regard. I was very, very excited to see this actually be one of my best tweets because I think it's something that is kind of underrated right now. So I appreciate for those of you who gave a like and retweet and follow me over at Twitter. I appreciate that. You guys seem to like the tweet. But basically, I did a quick tweet talking about how I felt many people were ignoring a very key factor, and that was something that I picked up about a week ago when I was looking at the chart for Bitcoin, and that as of today, towards the close of today, if we hold above 6,000, the Bitcoin will have held 6,000 for over a year now. Let that really sink in, guys. I understand there's been a lot of bearishness and there's been lots of I would say, not only consolidation in price, but also just a lot of emotion in this market, guys. We've been really beaten, I think, down by the bear market, reminiscing over the crazy run-up of 2017. It's understandable why some people are a little bit upset, but it's important to understand these things for the longer term cycle. I know many of you are here for the long term like myself, and whether it be for an investment perspective or for the fundamentals of this space or a little bit of both, it's important to understand that this is an extremely big pinnacle, and it proves that Bitcoin is building a store of value. So I want to go ahead here. I'm going to actually bring the chart over to Bitstamp for the first few points here. But again, we can see on the daily, we've been building a base right at the base before the ridiculous rally factor of 2017. Now, a lot of people here, I'm going to go ahead and take the drawings off as well as the moving averages. A lot of people would say, Nick, I think, for example, one of our top replies on the tweet was, yeah, whatever, Bitcoin may be a store of value, but the swing from 1,000 to 20,000 to 6,000 isn't very good for Bitcoin. Not to mention the people who bought up here obviously aren't seeing Bitcoin work as a store of value. And I think this is, again, I think some genuine concerns from people. Obviously, we want to have Bitcoin be, I guess, relatively stable in the long term, but at the same time, people like its volatility. The fact of the matter is, though, is that a store of value, this is a big misconception, a store of value can be volatile. Let me repeat that. A store of value can be volatile in the long term. So why is it important to state that? And what is a store of value at its core? Well, we've talked about this before on the channel, but I understand not all of you get to watch all my videos, so I want to spend a second clarifying that. A store of value, even though it may be desired to be less volatile, a store of value requires that for the mass majority of its history, whatever financial asset we're talking about, gold, silver, in this case Bitcoin, that when I enter into this given asset or commodity or whatever it is, that the moment I put in capital into this different type of financial product, that for the majority of history, I will be able to get my original investment back, if not more. Okay, that is really the only fundamental aspect of a store of value, because it's supposed to retain my purchasing power and another stable means of purchasing. So, for example, the dollar or some other type of world currency. So, I mean, again, if you take a look at this chart, if you're really looking at 2017 and 2018, it might not seem like a great store of value. But let's take a look at Bitstamp here. Bitstamp's been trading since 2011. It was the actual exchange that I first saw Bitcoin on back in 2011, back here when it was $3 back in November. But anyways, let's not reminisce on those days. Let's go ahead and focus in on the fact that, let's take a date range here. I really just see how much months a Bitcoin has acted as a store of value. So if you bought within really these 4 months here during the peak mania phase of Bitcoin, yeah, you might be down on your money or just slightly down or neutral, whatever. But we can see here that for the mass majority of Bitcoin's price, that you are way up on your money, if not, again, if you bought here in October, neutral on your investment. And this is exactly what a store of value historically does, and it does it multiple times over multi-year cycles. Take a look back here at Bitcoin in 2014 and 2015. There was resistance back here in 2013. Price broke way through it. Again, a parabolic rise with a parabolic correction, 80% down towards this level where there's previous resistance, and now it had turned into support. And it allowed for a longer term uptrend. So, you guys, the reason people say this is essential, I know it seems quite stupid for people to say, oh, it's good to see the price going down. Well, there is a little bit of fundamental good when you see price being able to build a higher base. This is what stores of value do. They build higher levels of support to see if they can make larger moves in the long term. And again, it allows for people to build confidence to enter liquidity in this store of value, especially when there's fearful markets and equities and other traditional currencies. That's where Bitcoin is probably going to become a hedge. It's going to be a hedge in the sense of fear and doubt in regards to traditional currencies and traditional equities. Again, I'm a little bit of an oddball when it comes to that point. Most people don't believe that. But I understand technically what Bitcoin is, and the institutions of the world understand that, those who have done the research. And I think more people will come to understand it over time. So I want to spend some time, now that we've talked about this and how I've gotten to kind of explain my tweet here, I'm going to go ahead and delete some of these things here. And we'll go ahead and take a look at really the 3 things that I want to see in Bitcoin in order for us to move higher. And I think all 3 of these are relatively essential. So let's go ahead and take a look at the first one here. We're going to jump over to something. I know we don't always take a look at it, but it's a very important chart to take a look at in regards to the long term. And that's the logarithmic chart. So on the log chart here, there's been a very interesting uptrend that many people have been talking about. I've been keeping an eye on it for a while, but it's generally the fact that Bitcoin historically has held an uptrend here. This is really the real uptrend line that we can build here, building a base on some of the outer band price action here from the base at $3. Now, I want to bear in mind a few things here, guys. I think that we're getting to a point where in a month or two, we're going to start to ride up on this uptrend line and we can start to see some upside price action. Again, once we make contact with this, I think we're very likely to start seeing an uptick in price. How drastic, I don't know. But I do want to say as well that a lot of people are selling a lot of pipe dreams in regards to on TradingView and all these trading applications in crypto Twitter. And that is that, on the log chart, as we can see here, this means that we're going to get a major upswing in price where price is going to come up to this range like it has in the past, and it's going to be $150,000. Look, the fact of the matter is, guys, is that we're probably not going to see that major of an upswing on the logarithmic chart. One, because we didn't have, if we do start to get a curve up here, we didn't get as long of a correction as we did back here. And along with that as well, it gets a little bit more ridiculous when you start saying that you can reach 150,000 and 250,000 and $1 million by 2020, guys. Unless we have a dollar crisis, we are not going to see that. It's fundamentally understandable, again, if we get a dollar crisis. If the dollar loses 80-90% of its value, people start to lose faith in world reserve currencies. Again, you've got to ask if that's plausible in the next year or so. I think we're stepping to that in the longer term of things, but I don't think we're going to get that next year. The U.S. is still quite strong. So again, either way, I think this is still something to look forward to. Good sign. We need this to make contact with that logarithmic chart and start building a slow support along the logarithmic chart in that case. Going back here to the normal chart, though, and taking a look at price action, there's a few other things that I want you all to keep an eye on. Going here to the weekly, I definitely want you guys to keep an eye on the 100 week. We are getting very, very close to gaining support on this key moving average that is definitely essential to watch. The 100 and 200 week are great for detecting when moves are going to be made in the long term, when we can build support on it. Again, I don't think you're going to see the 200 week. It's too far away. I think more than anything, this market wants to see higher levels, but it needs to hold some support on one of these major moving averages. And over the past month or so, we've gotten very, very close to it. So give it a few more weeks. I think we'll eventually hold contact on it, hold it for a week or two, and then we'll start to really see some up moves. How soon we get there, I don't know, guys. So we'll have to be a little bit patient. Now, I want to jump over to Coinbase because the third thing I want to talk about is pretty self-explanatory. We need to see volume, guys. I don't know if we're going to get a catalyst or the technical price action is enough to bring in new investors, guys. To be fair, right now, outside of Bitcoin's price going to 6,000, where miners are coming in and buying it, investors are coming in and buying it, whoever it is, doesn't matter. The fact of the matter is that we do not have enough actual trading volume to push markets higher. Again, the market is awash with market makers and algorithmic trades going on right now. There's no serious retail and institutional volume. So we need to get that in the market. So those are the three things that we need to see in order for price to move higher in my book. I'd love to hear down below in the comments, guys, what you believe is essential for prices to move higher. So let's go ahead and go to the last two pieces here on crypto. Now, guys, as always, you guys know, as you've probably noticed, I've been working with Unibright for months. I try not to talk too much about the projects I work with because I do not want to shill. As you all know, I tend not to talk about ICOs in general or altcoins. But I do want to say that Unibright recently has released its public demo here. They just released the framework, which is the software tied to Unibright, and they just did a demo in regards to one of their recent events. And this is a demo of the platform that's going to be coming out in the first quarter of 2019, where we're actually going to see real enterprise companies be able to utilize this to build smart contracts for things like multi-party approval, supply chain logistics, etc. Really recommend you guys go check it out. Again, it's the reason I've been supporting Unibright, one of the best teams out there in the space, in my opinion. A great team of software developers out of Germany. So again, look into it. Great community, great ecosystem. Very happy to see the Unibright dream coming alive. So I want to go here and talk about Tether. Now, we've obviously been talking about the fears with Tether back over the past few weeks, ever since we got the big bump up in price, and I've been talking about it for months. I'm happy more than anything, though, that we don't have some crazy flash sale in Tether, that we haven't had a collapse in Tether. And in fact, we're starting to see the slow demise, just like we do in altcoin projects that don't really hold much fundamental value. We're seeing the same in Tether. And it's not through Tether just simply losing its trust or value, but the fact that people are migrating to better options. Again, it's a free market of currencies. We can see it in these three charts, and I got to say, I very much want to give credit to David from CoinDesk, because this is a really quality article. I like when they actually bring good charts and data into the equation. So going on here, we've got market cap first, and we can see, again, it's really not too drastic if we take a look at the chart. We can see a very clear downtrend here. in market capitalization for USD Tether comparative to stablecoins. And you've got a big set of competition here. You've got GUSD, USD Coin, PAX, TrueUSD, and stablecoins like DAI. Now, this isn't that much. Again, this is only calculating from 100% to 75%, but this is within 1 month. This is a daily basis. So if we continue to see this trend over the next 4 or 5 months, it is going to set a major precedent against Tether in this case, and it's showing that the market is making a major shift. So a very important macro trend to keep in mind. And there's 2 other charts here as well we can take a look at. Volume as well, diminishing at a relatively decent pace for a monthly basis. For exchange volume of stable coins. Go ahead and let you guys get a good view. And then it get a little bit bouncy, and the reason why is because you're going to get market makers trading on these different things, guys. And especially as these new stable coins are coming into the equation, they don't have as much pairings, as well as generally just again, I would say liquidity is really the biggest concern in this case. A lot of larger traders can't trade on it until there's obviously more and more volume coming in, more and more of these stable coins being traded. Again, seeing as a lot of these actually have a pegged ratio, you need to guarantee that there's enough of them in circulation where people can actually buy and sell them. So very important for that. But again, that's only going to pick up over time. And same goes for on-chain transaction volume. It's good to see that there's some bigger swings here. So new entries of actual dollars for the pegged currency in this case. So still very, very awesome. Again, Tether is still dominant nonetheless, but this is what competition looks like, guys. It's exactly what we need. It's important to see alternatives coming in, because I can tell you, not only do I believe that Tether is not good enough for institutions with the worries that are tied to it, but along with that as well, if it's still good enough for institutions, it's sure as hell still not going to be good enough for governments. And governments want a regulated stablecoin. They want something that has auditing tied to it, because anything tied to the dollar, they're going to definitely in the long term make sure to set the regulatory hammer on. So long as it plays by the rules, it won't be a big worry. But again, you can bet that the government's going to try to get the best option out there. Alrighty, so going on to traditional markets, stepping away from crypto, I'll go ahead and refresh the pre-market page here. We can see the indices are quite scattered across the board. Dow Jones and S&P 500 relatively neutral, with the Nasdaq up 0.5%. Really, futures are unchanged. A few hours ago, they were down in the red. Doesn't really matter, guys. We'll have to see how the markets open up. Again, as you can see, it's 5:30 a.m. on the eastern shores where I'm currently living. And again, I want to mention as well, guys, as you probably noticed, I'm doing videos a little bit earlier. Again, I want to make sure to get these out a little bit sooner for you guys, whether you're on the East Coast or anywhere across the world. But I think it's better to try to get up a little bit early and get the news out so you guys can see it from wherever you guys are. But anyways, I'm rambling. Let's go ahead and talk about some big news in traditional markets. In a desperate move, I got to say, there's really no other way to describe this, guys. I think it's a decent acquisition, but man, I mean, this is just amazing. IBM has recently engaged in one of the largest acquisitions in history, a $34 billion acquisition on Red Hat. Now, as some of you might know, Red Hat is a big distributor of Linux, which is obviously used on the back end of a lot of different infrastructure pieces in regards to the tech sector. But more than anything, this seems, again, like a desperate move with the decline in revenue from IBM ever since really 2008. We have not seen major growth in IBM as other tech companies have come into the space, as tech companies have killed it. And, you know, I know, for example, I'm a big fan of Watson, which is what IBM's been working on. But outside of Watson, which is still very speculative and early on, we have not seen any killer products coming out of IBM. And again, this goes to prove, guys, that we're getting towards the peak of a market cycle. When you see the ridiculous cash-based acquisitions of picking up these companies, kind of mid-sized companies, and paying a double premium on, or it's not so much double premium, but about a 1/3 premium on the market valuation, where Red Hat now, pre-market, is trading up 50%. So again, very, very crazy to see this kind of price movement and this kind of, you know, $10 billion premium on market valuation, where they're pretty much spending, again, an extra 10, actually in this case, they're going to be closing the acquisition. Again, markets try to leave a little bit of leeway until it's closed, but pretty much $14 billion on top of what it was already trading as. I mean, again, it shows a little bit of desperation, guys. And this is, again, the kind of ridiculousness you see, the mismanagement of capital that these companies are already dry on after all the stock buybacks and all the acquisitions. again, the mismanagement that you see tended in regards to the peaks on market cycles. So again, make of it as what you will. I think Red Hat's a good company, but at the same time, I don't know if I believe it's worth $34 billion. So anyways, want to go on here, take a look at a few articles here, and then we'll go ahead and jump into looking at the charts. There's a really nice article here by Chris Anstey talking about how the bar is high for the Fed to help investors, Morgan Stanley says. I think this is a very interesting article because of the chart here that showcases how over the past few years, the effects that the Fed's quotations and the Fed rate hikes have had on the market. We've seen obviously how Janet Yellen had put off the rate hike here. Put the first hike here, sparked some fear in markets, but as we recouped, we started a much more clear campaign of rate hikes over time. And it's looking like over the past year, really, seeing as we've started to close down 2018's gains, that we're starting to fear these rate hikes and also feel a little bit of the pain. Now, we'll go ahead and look at some data points here, but I do like how they pointed out a few key things. I think all of these are important to keep in mind. So first off, gold and oil prices tend to do best in this scenario. Energy stocks typically outperform the broader market, and emerging market equities do better than U.S. ones. Again, why I'm focusing in on commodities, because all these have to do with commodities. Energy stocks predominantly are oil, natural gas, and I mean you could talk about solar and alternatives like that, but really I'd say uranium and nuclear energy in this case is going to be the one that's going to get probably a rebound. Again, plays that are much more, I would say, stable in the long term, especially now that commodities, a lot of which are still relatively cheap, some of which have bottomed. Along with that, natural gas, along with gold, moves from one of the worst investments. Again, gold has not done that well. Natural gas has been relatively stagnant or declining to one of the best returns in this market. Again, going into commodities, this is a pretty self-explanatory thing. U.S. stocks, credit, and the dollar index do materially worse in a faster inflation, slower growth combination compared to when both are accelerating. I would say one thing here is that the dollar is probably going to push sideways, if not push a little bit higher actually, and break against this common trend. And the reason I say that is because I think we're going to see a continued collapse in emerging market currencies as the problems grow worse there. Along with that as well, we have European and Japanese stocks currently having the most attractive risk and reward balance. And this is pretty self-explanatory, guys. It's because in Japan, you have negative interest rates, and in Europe, you've got 0% interest rates. You know, the EU just got out of quantitative easing. The US has gotten out of quantitative easing years ago. So, again, if you're in that risk-on nature, you obviously want capital to be practically free in this case, and well, that's what you get with Europe and Japan at the moment. It's pretty much printing money for free and being able to go out and buy up equities and pretty much buy whatever you like, paying little to nothing. So again, it makes sense. It makes sense in that case for people who are still risk on to go to markets that have not only had a pullback as Europe and Japanese stocks have, European and Japanese stocks, but along with that, low interest rates. So I want to go to some data points here to talk about a few key things as we talk about, again, a contraction in markets. Some of these we've already taken a look at, but as we talk about, rate hikes having an effect on the market, this is a really good visual indicator to showcase that. We can see here new U.S. home sales, again, are depleting at a pretty rapid rate here, and we can also see as well, I'm sorry, it keeps on wanting to spam, asking me for notifications. We've also got as well United States pending home sales, where for pretty much the past year, on a monthly basis, we've seen consistent declines. Now, those declines have obviously been shortening here, really over the past month, but as we can see here, over the past year, there has not been any positive growth in 2018. And I think this is why a lot of people are getting fearful that we're starting to feel the pain of rate hikes. Now, again, I've talked about this before, but I want to emphasize it. For those of you out there who are interested in kind of studying macro trends and understanding the ramifications of interest rates, there is no telling exactly what interest rate is too much for markets at the exact time it happens. Like, so for example, if the Fed raises rates to 3%, the market can kind of guesstimate, is this going to be enough to pull back the economy and establish a recession, or is the market going to keep chugging along? The problem is that it takes a few months to really feel the pain of an interest rate hike and also lowering of interest rates as well, because it takes time to see a change in trend for borrowers and lenders as well. So again, in this case, I think we're starting to see a very clear picture that after almost a year's worth of declines in pending home sales, that there could be a big issue here. And also, as well as that, auto sales are quite stagnant. We have not seen a massive depletion. I will say I'm actually quite impressed by total vehicle sales still holding up here with the general trend line. The thing I would say here is to watch for a break on 16 million over the next year or so. And if you get that really in the next few months, I think that's going to be very, very interesting to see. And again, you could be very well setting up for the depletion like we saw back in 2008. But I think it's going to be over slower, longer grind as we talked about beforehand. But man, automotive sales, and the amount of overproduction is quite concerning if you've actually studied that. But anyways, just thought I'd mention that. And again, I think also something as well, I don't mean to ramble here, but technologically, I'm really interested to see these numbers just simply stagnate over time and go down to practically nothing, because not only would I like to see cars last longer, but also I think you're going to see a really big trend of ride sharing with autonomous vehicles that can actually drive. I know that's a big thing that Tesla's been working on, and I think a few other companies are going to try to copy that. And it's actually going to be a big replacement for companies like Uber, in my opinion, where people, when they're not using their cars, they can actually rent it out to others to drive around. So it'll be pretty interesting to see if that actually comes to fruition. But depends if there's really enough demand for driving cars outside of the hour that people really need their cars, which are 9 to 5. So anyways, let's go ahead here. Let's take a look at equities real quick. Again, price action really unchanged here, obviously, because trading hours haven't started. But man, it is going to be very interesting if we do not see the Qs, in this case, I'll go more specific with the names, the NASDAQ, the Dow Jones, the Russell 2000, and the S&P 500 really pick up pace here, guys. I mean, we've broken away from the trend line that's been held since back here in 2017. And along with that, we are well below the 200-day moving average. I think, again, what you very likely have here is a depletion towards some key support levels here. I think in the long term, again, you're going to get the NASDAQ down a good 50%, as well as the Russell 2000. We talked about this. I probably should be, that's why I wasn't getting my lines here, because I was looking at the ETF rather than the index. But I think the Russell's coming down to the 200 week here. Very, very likely to see something like this. And again, making previous resistance support. After we get down here, guys, I'm going to play rebound play. I'm going to trade equities, especially things like URA, a lot of the commodity safe plays. I'm going to be playing these as we start to get a rebound up towards probably around 1,500, around where we are right now on the Russell 2000. And I'll be trading against some of the small caps as well, taking some risk after this massive correction. But again, I think we've got a good another week or two of sell-off. We need to really close October in a bearish trend, and I think we're going to get that. But going on to the NASDAQ here, let me go ahead and take a look. Again, I think in the broader term of things, you're going to see this come down to, again, the line here that is served as resistance in this case, and then obviously in the long term as well, what was previous resistance now becoming support. Again, 50% correction in total. So no serious changes here. Again, as we talked about, pre-market's pretty much neutral at the moment. We'll have to see how markets pick up pace, but I can tell you the chart does not look pretty, put it simple. So going on here, let's go ahead and take a look at commodities. Gold, I think you need to see gold come down onto the 100-day. If we can get a roll down here, hold support, and rise up, that'd be very good. Silver, again, is my personal play. In regards to the two, I think silver, again, with the gold to silver ratio is the optimal play. Or the 50-day, rolling flat here. I think price needs to come down, tap off here one more time, and then we can really get a nice uptick towards the 200-day. And now many people were concerned as well about URA here. URA did get a little bit of a dip here below the key support line. And this is obviously because these are equities, guys. These are stock plays in regards to the uranium sector. And they cover a pretty broad amount of markets in this case, because obviously there's a lot of players who are involved in the uranium space that aren't specifically focused on uranium. Now in this case, I don't think this is a make or break moment, guys, to have a slight break here. If you saw it diverge and go down past $11, yeah, I'd be a little bit concerned. But if we take a look here on the weekly, in the grand scheme of things, I think honestly it's still holding in the same range. And some people as well would say, oh no, you should lower the support line and everything. Look, guys, to be fair, again, until we see a good 2 or 3 days continuing the sell-off past this key support level, I'm not too worried. I think you're going to see if equities get a rebound, you're going to see URA get a little bit of a rebound. And it's got enough plays that are nice hedges in a risk-off market in this case. So again, with uranium prices and the spot market doing quite well, I'm not worried about this. If anything, I like to see discounts like this where I can get things a few cents cheaper. So again, not telling you guys to buy anything, just letting you all know how I think. I'm not worried about it. I know some people pointed it out on Twitter, but just keep an eye on it. Again, if we get another 2 days of divergence, that might be a little bit concerning. As much as I love this long-term trend, I can't wait to hopefully see this break out to the upside. I really do hope it happens. But anyways, that's it for the video, guys. I rambled on long enough. I hope you guys are having a wonderful day wherever you are. Again, if you guys have anything you guys have in regards to questions, definitely leave it down in the comments down below. Get a discussion going as always. And I'd love to hear what you guys want to see in the next video. But until then, thank you all so much for watching, and I'll see you all in the next one. Stay tuned.